An ETF is a fund you can buy and sell during the trading day, the same way you buy a share of a company. That is the short answer. The longer answer is more useful because the thing that makes an ETF work is a mechanism almost nobody explains. And once you understand it, a lot of other questions answer themselves. I run an ETF business, so let me walk you through it the way it actually works. Start with what you are buying. An ETF holds a basket of things. It might be 500 stocks or 10 bonds or a mix of both. When you buy one share of the fund, you own a slice of everything inside it. That part is the same as a mutual fund. The difference is how you buy it. A mutual fund trades once a day after the market closes at whatever the holdings were worth at 4 o'clock. An ETF trades all day long on an exchange at whatever price a buyer and a seller agree on in real time. Which raises a question most explanations skip right past. If the price is set by buyers and sellers, what stops it from drifting away from what the fund actually holds? A fund holding $100 of stock should trade around $100, but nothing in the mechanics of an exchange forces that. Traders set the price and traders can be wrong. Here's the answer, and this is the part that matters. Every ETF has a small group of large trading firms attached to it called authorized participants. They have a privilege nobody else has. They can go to the fund and create brand new shares or hand shares back and destroy them. Say the fund holds $100 of stock, but the shares are trading at 101. An authorized participant buys the underlying stocks for 100, delivers them to the fund, receives new ETF shares, and sells those shares at 101. They keep the difference. And because they just created new supply, the price falls back toward 100. If the fund trades at 99, the trade runs in reverse. They buy the cheap shares, hand them to the fund, take the stocks back out, and sell those. The price rises back toward fair value. Nobody is doing this out of goodwill. They are doing it because there is a dollar in it. And that profit motive is what keeps the price honest all day, every day, without anyone supervising it. Once you understand that mechanism, 3 things follow that would otherwise look like coincidences. First, ETF prices track their holdings closely. Not perfectly, and the gap widens when the underlying market is thin or closed, but closely most of the time. Second, most ETFs are more tax efficient than the equivalent mutual fund because when a big holder exits, the fund can hand over stocks rather than sell them. No sale means no capital gain passed to everyone else. Third, an ETF that trades in low volume is not necessarily hard to trade. Its real liquidity comes from what it holds, not from how many shares changed hands yesterday. So what should you actually look at before you buy one? 4 things. What it holds, which is published every day and worth opening at least once. What it costs, meaning the expense ratio charged quietly out of the fund every year. How wide the spread is between the buy and sell price, because that is a real cost you pay on the way in and out. And whether the fund does what its name says, which is a question the name alone will never answer. That is an ETF, a basket you can trade like a stock, held near fair value by a group of firms with a financial reason to keep it there. The wrapper is simple. What matters is what somebody put inside it.